$18 million. That's the pocket change Peter Lynch started with in 1977. By 1990, he'd compounded it into a staggering $14 billion. That's a 29.2% annualized return for 13 straight years. Let's address the elephant in the room right now. Lynch was the biggest institutional whale on Wall Street. But here's the fascinating part. He didn't crush the market using complex institutional algorithms. He beat the smartest minds in finance by thinking exactly like a retail investor. While other fund managers were glued to their screens, his best ideas came from his wife noticing legs pantyhose in a regular supermarket. If the greatest institutional investor in history found his edge in a shopping cart, imagine the structural advantage you have. Wall Street's paralyzed by heavy regulations and endless committee approvals. They literally can't touch small, promising companies early on. But you can. You just need to know where to look. You can't treat all stocks the same, so let's break them down into 6 simple buckets. First, you've got slow growers. These are massive mature companies paying steady dividends. Then you've got stalwarts, giant bulletproof companies like Coca-Cola or Procter & Gamble acting as a massive defensive shield for your portfolio. Next are cyclicals, companies like automakers where economic timing's everything. Then there are turnarounds. Think of Chrysler in the 1980s, a company on the brink of bankruptcy that rewarded brave investors massively when it recovered. And don't forget asset plays, companies hiding immensely valuable real estate or patents that Wall Street misses, just like when Lynch found hidden value in Pebble Beach golf courses. But if you want a true Tenbagger, a stock that multiplies your money by 10, you're looking for the 6th and final bucket, fast growers. These are small, aggressive companies expanding at 20% to 25% a year. But let's get one thing straight. You shouldn't blindly buy a stock just because it's growing. A great company's a terrible investment if you pay the wrong price. This is where Lynch popularized the PEG ratio, comparing the price-to-earnings ratio against the company's growth rate. If you overpay for growth, you'll lose money. So, what does a perfectly priced 10x stock actually look like? It's incredibly ugly. You want companies with extremely dull names operating in depressing industries like waste management or funeral homes. Nobody wants to talk about trash collection at cocktail parties, meaning there's zero excitement and zero media coverage. You want a neglected niche where Wall Street suits simply refuse to go. Look for consumable products people repeatedly buy even in a deep recession, or companies where insiders are aggressively buying their own stock with their own hard-earned cash. But for every hidden gem, there's a toxic trap. Don't fall for the FOMO. There are 3 toxic traps you must avoid at all costs. Number 1, the hottest stocks in the hottest industries. Intense competition will destroy their profit margins before you can even blink. Run away from any stock hyped as the next Tesla. They're almost always dangerous fakes trying to steal your money. Number 2, companies heavily relying on just one single customer for 25% to 50% of their total revenue. If they lose that client, the stock goes to zero. And number 3, diversification. Watch out for companies blowing cash on completely unrelated, stupid acquisitions. It's a double-edged sword that usually ends in total disaster for the shareholders. Let's make one critical concept crystal clear. Stock prices bounce around wildly every single day based on random news and sheer panic. But if you zoom out, the stock price ultimately follows the earnings line. Picture a solid, thick line going straight up and to the right representing the actual profits of a company. The stock price is just a thin, chaotic line jumping up and down all around it. It might deviate for months, but eventually, the stock price acts like a powerful magnet pulled right back to the earnings line. Over the long run, stock prices strongly correlate with earnings. You're tracking corporate profits, not daily price changes. So you've found the perfect boring stock at the right valuation. But none of this matters if you lack the single most important organ in investing. And no, it isn't your brain. It's your stomach. Market crashes are as routine as a January blizzard in Colorado. If you don't have the guts to quietly endure a 10% or 25% drop, you shouldn't be in the stock market at all. Sitting in cash out of pure fear causes far more missed gains than actual crash losses. When the market tanks, people throw away great businesses at a massive discount. That's your ultimate buying opportunity, not a time to run away. Please don't commit the ultimate sin of cutting your flowers to water your weeds. Stop selling your massive winners just to hold onto your losers, hoping they bounce back. Before you hit the buy button, put yourself through the 2-minute drill. If you can't explain exactly why you're buying a company in under 2 minutes using language a 5th grader would easily understand, drop the idea immediately. Saying the stock's going up is never a valid thesis. Do your fundamental research, persistently track the earnings, and if the story hasn't changed, sit on your hands and let time do the heavy lifting. The greatest stock you can possibly buy might already be sitting right there in your portfolio. If you want to learn exactly how to value these fast-growing stocks, hit the subscribe button and watch this video next. See you in the next one.